Well, interest rates are rising again, and if you are wondering why, you are not alone. But the truth is, this is not random, and it's not just because of the Fed. Um, yes, on Wednesday, the Federal Reserve met, and they decided that they were going to leave the federal interest rate the same. They're leaving it unchanged. They've also made the announcement that they are taking any rate cuts this year off of the table for now. And so, of course, that does impact what happens to mortgage rates. But over the last several weeks, really and truly, just in the whole month of March, we have seen mortgage rates start to trend back up. And we were going into the spring really thinking that, yes, finally, we're going to see some reprieve on interest rates. Interest rates were trending down. We even saw the news talk about how some interest rates even touched the fives. And then here we are, 3 weeks later, watching interest rates climb up. But the truth is that mortgage rates change every day, and they change based off of the economic data that is reported. So the biggest factor in interest rates right now is inflation. Now, inflation is down from its peak, which is great news, but it's still higher than what the market really wants to see and what the Federal Reserve wants to see. So when inflation stays elevated for longer, it what that causes is investors to demand a higher return on their investment, which then causes mortgage rates to increase to be able to give that return that the investors are demanding. Now, another thing is that mortgage rates are tied to the 10-year Treasury bond. You may or may not know that, but if you ever want to see, kind of get a gauge for what mortgage rates are doing, look at the 10-year Treasury yield. If you see that the yield is going up, you can pretty much guess that the mortgage rates are going to go up. But if the yield goes down, mortgage rates are more than likely going to be trending down too. Now, that's a loose, it's a loose tie, but it is still good to kind of gauge where the market's headed that day. But again, when bond yields go up, mortgage rates go up. And right now, investors are pricing in a lot of uncertainty. They are very uncertain of inflation and where inflation is headed. And so now, as a result, they're demanding higher returns. But this is what really surprises most people is that a strong economy, like good jobs reports, strong customer spending, actually can keep mortgage rates higher than you would expect. And that's because it signals that inflation may stick around longer. Again, basic economics 101, supply and demand, right? The more supply, the less demand, the higher the prices go. So why is this so important to understand is because a lot of times when people are trying to time the market, they want to buy when interest rates are coming down. As interest rates trend down, we notice a lot more people starting to inquire about home ownership. We start to notice a lot of people inquiring about selling their homes. And when the truth is, buying a home should not be timed based off of how the market reacts, because the market reacts differently every single day. As interest rates drop and demand surges, that just again increases prices because once again, supply and demand. The less the less supply, the higher the demand, the higher the price. So when you're counseling your buyers and you're counseling your sellers, it's really important to emphasize that there's no real perfect time or perfect market conditions or perfect interest rate because it doesn't really exist. When the truth is, waiting can cost you more in the long run through higher prices, multiple offers, and the key, less negotiating power. So, what we really want to focus on is making sure that we're still staying within a comfortable payment, focusing on being in a less competitive market because that's where the buyers really get the wins. And then also reminding our clients that they can always explore refinancing their loan down the line, whenever that time is right. Again, key point is that they are at least comfortable with the payment that they're making. In Hampton Roads specifically, we're still seeing really steady demand. We're still seeing a lot of our military, as they PCS here, still looking for places to own. First time home buyer activity is still ticking up. Inventory is still tight. And so, with that said, homes that are priced right are moving very quickly. So, the key going into the market is having those homes priced correctly to sell, not really testing the market because even though there is a lot of buyer demand, a lot of pent up buyer demand, buyers are still being very, very sticker conscious. that if they don't feel like they are getting the best deal because of interest rates being higher, then they will pass on a home that they feel is overpriced. But if you are considering buying, or you've got somebody who's considering buying this year and they really want to understand what these mortgage rates mean for their specific situation, it's all about the strategy and building out a strategy that helps your clients win in the market, regardless of interest rates, whether they go up, they go down, they stay sideways, whatever. It's all about making sure that we are building that strategy that works for them.